Welcome to Talk Tickers. We're here to unpack the market-moving events, giving you the core insights you need.
And today, we're diving into Morgan Stanley's Q3 2025 earnings call.
Yeah, this one landed right at the market open, and, well, it definitely made waves.
Yeah.
Wall Street's expectations got a serious reset.
A reset is putting it mildly.
Yeah.
I mean, the consensus wasn't just beaten. It felt like it was left in the dust. This quarter wasn't just good numbers.
No.
It felt like real validation for their whole integrated firm strategy. It really hints they're catching a wave, maybe a multi-year upswing in capital markets.
And you saw that immediately in the market reaction, didn't you? The stock just surged. New high, heavy volume.
Exactly. It reflected the record performance, sure, but also that incredibly bullish tone from management. Very confident commentary.
Yeah, less about just recovery, more like shifting gears into a new growth phase.
Okay, so let's get into the headline numbers because they really tell the story of just immense operational leverage kicking in.
Right. Top and bottom line. A really strong beat on both.
So the GAAP EPS, earnings per share, landed at $2.80.
$2.80. And consensus was what? Hovering around $2.10? $2.11?
Yeah, somewhere in that $2.08 to $2.11. So you're talking a beat of nearly 70 cents per share. That's significant for a company this size.
Huge momentum signal. And revenue.
Revenue followed right along. A record $18.2 billion. The street was expecting maybe $16.7 billion, so well above that.
That's an 18% jump year over year.
Right. And all this translates into a return on tangible common equity, the ROTCE, of 23.5%.
23.5%. That is a seriously strong return for a major financial institution.
Definitely. And management, they were quick to frame it. They pointed right at the operating leverage from their integrated model.
They used that phrase, didn't they? The capital markets flywheel taking hold.
Exactly. It implies all the pieces are working together now, turning that cyclical market strength into real sustained profit.
Okay, let's unpack that flywheel then, starting with the cyclical part. Institutional securities. This seems to be where the immediate power surge came from.
For sure. Investment banking revenues saw this, well, genuine resurgence, a huge jump, 44% year over year, hitting $2.11 billion.
So the deals are really flowing again.
No question. And it's broad-based. You look at ECM fees, equity capital markets, so IPOs. Secondaries, they just skyrocketed, up 80% to $652 million.
80%. Wow, that's the IPO market waking up.
Palpably reopening, yeah. Then you have advisory fees, so M&A work, up a very healthy 25% year over year, $684 million there on more completed deals.
Okay, solid.
And it wasn't just equities. Fixed income underwriting was strong too, up 39%, $772 million. That shows strength in both investment grade and, non-investment grade debt issuance.
So it's not just one niche firing, it's liquidity returning more broadly.
Right. Now here's where it gets really interesting competitively.
Yeah.
Equities trading revenue. $4.1 billion.
$4.1 billion. Up how much?
Up 35% year over year. A huge number. And management made a point of saying they reclaimed the #1 spot this quarter.
Ahead of Goldman Sachs.
That's what they affirmed, yeah. Outpacing Goldman in equities trading. And a lot of that strength came from prime brokerage, serving hedge funds. Record balances there. Plus, strong derivative results.
Okay, so the trading desks are humming. But what really jumped out was the forward-looking stuff, right? The pipeline commentary.
Oh, absolutely. This is where you start to hear some really big claims. Management described the investment banking pipeline as being at an all-time high.
An all-time high. Okay, that's strong language. That's leaning in.
It is. And they didn't stop there. They suggested 2026 deal volumes could actually surpass the crazy levels we saw back in 2021.
Surpass 2021, driven by what specifically?
Sponsor-led IPOs, mainly. Private equity getting ready to exit investments. Management basically painted a picture of entering a multi-year period where IB activity is just up and to the right.
Up and to the right. They even made comparisons, didn't they? Like mid-90s, mid-2000s type cycles.
They did. Which, that's an enormous claim. And it raises that key question for you listening. Is that conviction truly justified? The quarter was great, no doubt. But those comparisons imply a sustained multi-year boom.
Right. What's the underlying logic there? What makes them so confident beyond just near-term momentum? Is it just macro hope?
Well, part of it seems to be this view on AI investment. The idea is that many companies need M&A activity to basically cover, or defease, as they put it, the huge upfront costs of building out their own AI infrastructure.
Okay. So smaller players realize they can't afford the AI arms race on their own.
Exactly. It forces them to consolidate or sell, which just keeps that M&A advisory pipeline full for a firm like Morgan Stanley. That's the potential long-term fuel they see.
Okay, so that's the cyclical engine, potentially fueled for longer than expected. But, you know, that kind of growth is inherently volatile. For the stock to hold a premium valuation, you need the stability factor too. Where's the durability in this story?
And that brings us squarely to the other side of the integrated firm, wealth management, the durable engine room, as you called it.
Right.
And it delivered record revenues here too, $8.2 billion. That's up 13% year over year. And really impressive margin strength, holding steady.
The pre-tax margin was, what, over 30%?
It reported 30.3%,
Yeah.
which just underscores the operating leverage they've built, especially now the big acquisitions are, fully digested.
But they made a point about that margin, didn't they? That it's an output.
Crucial point, yeah.
Yeah.
Management stressed that 30% is an outcome, not an input they're chasing at all costs. They want to make it clear they're still investing strategically in the platform for the long haul, not just cutting corners to hit a number.
And those investments seem to be paying off in terms of scale.
Definitely. Total client assets firm-wide are now $8.9 trillion, and $7 trillion of that is in wealth management alone.
$7 trillion. Wow. And asset gathering, net new assets.
Still strong. NNA came in at $81 billion for the quarter. Importantly, $42 billion of that was in those sticky fee-based flows.
And that internal funnel they've built is working well, moving assets from the workplace channel.
Very well. Assets coming from employee stock plans, 401ks, that kind of thing. They continue to migrate into the advisor channels. And that migration rate is actually running ahead of their historical expectation, which was around $60 billion a year.
Okay. And the reopening IPO market helps there too, presumably.
Yeah, exactly. As employees at newly public companies get liquidity, those assets often transition right into advised accounts within Morgan Stanley. It's a nice synergy.
Now, one area of concern for banks has been net interest income, NII, right? With the Fed potentially cutting rates. What was the outlook there?
This is interesting. They actually expect to see a modest sequential gain in NII in Q4.
Wait, again, even with potential rate cuts, how does that work? That seems counterintuitive.
It does. And it speaks to some strategic positioning, maybe some hedging.
Yeah.
They pointed to two things. First, just consistent growth in lending balances, particularly securities-based loans or SPLs, where clients borrow against their portfolios. Second, they mentioned this historical pattern where deposit balances actually tend to increase when rates fall. Maybe clients move money out of other things back into deposits. It suggests a kind of built-in defense against those falling rates.
Interesting. So they feel pretty well positioned on NII despite the macro shift.
Seems like it. Now, about those strategic investments supported the platform, they got specific on AI, which was good to hear, not just buzzwords.
Right. What were the examples?
They highlighted three key tools. First was something called DevGen AI that's focused internally, helping their developers work faster, build new tools more efficiently.
Okay. Internal efficiency.
Second was Parable. This sounds like a pretty powerful data analysis and summarization tool, helping them make sense of huge amounts of information across the firm. Better decision making.
Makes sense.
But the one that really connects directly to that $7 trillion wealth business is called LIDIQ.
LIDIQ, what's that do?
It's basically an AI-powered system to optimize how they distribute client leads to their financial advisors, getting the right lead to the right advisor at the right time. That directly drives revenue conversion and makes advisors more productive.
So that's how you connect the investment dots back to potentially maintaining that 30% margin. Smart.
Exactly. And they're also focused on locking in clients earlier in their journey. They talked about the expanded Carta partnership.
Carta, right.
Right.
The platform for private companies, equity management.
Yeah. The focus there is on a referral model, getting in front of private market clients, startup employees, founders throughout their life cycle, offering advice before they even become liquid. The idea is to capture that wealth creation early and keep it in the Morgan Stanley ecosystem.
Very strategic. Okay, shifting gears slightly. What about the balance sheet, capital position?
Rock solid. Their main capital ratio, the standardized CET1, stands at 15.2%.
Which gives them a pretty big cushion above requirements,
A
right?
huge cushion.
Yeah.
They estimate it's over 300 basis points above what's required, well over.
And didn't they get a little help from the regulators recently, too?
They did. Management specifically mentioned a regulatory tailwind. The Fed reconsidered their CCAR results. That's the stress test buffer requirement. And that gave them about 80 basis points of capital relief.
80 basis points. That's significant breathing room.
Frees up resources, eases constraints. Yeah.
So with all that excess capital, what's the plan? Big buybacks, acquisitions.
The bias, they said, remains strongly towards organic investment first. Building out the bank. Digital assets, they mentioned, a partnership with Zero Hash, investing in platforms like eTrade Pro.
Okay.
On acquisitions, they were clear, very disciplined. Any deal has to pass a strict four-part test: strategy, culture, timing, and price. So don't expect splashy deals just for headlines.
Got it. So wrapping up the call's main message, the big picture they're painting is what?
It's one where Morgan Stanley is kind of uniquely positioned to benefit from several tailwinds at once. Investor appetite coming back, the M&A need driven by AI costs, a more stable regulatory environment.
And the key is that integrated model, right? The cyclical IB rebound balanced by the steady wealth engine.
Exactly. Providing earnings durability, as they put it. Even with all the geopolitical risks and market volatility out there, it's about having both engines running.
Mm-hmm.
All right, that brings us to our not financial advice segment. Time for an outrageous but plausible trade idea based purely on what we heard on the call.
Okay, let's hear it. This quarter's $2.80 EPS print was huge. It really shows the kind of operating leverage Morgan Stanley has when capital markets are, firing.
Right, and you combine that demonstrated leverage with that commentary.
Mm-hmm.
The all-time high IB pipeline, reclaiming the equity top spot, and that massive capital buffer, 300 basis points plus.
Yeah.
Maybe, just maybe, the market is still underestimating how sustainable these kinds of earnings could be if management's multi-year view plays out.
Okay, so the market sees the $2.80 but thinks it's peak-ish, maybe not repeatable consistently.
Potentially. Now, they did a $1.1 billion buyback, but they called it tactical. That excess capital buffer, though, that feels more structural, especially with the regulatory relief.
Right.
So if management is actually right about this multi-year upswing lasting through 2026, they're going to be generating a ton of capital, probably more than they can reasonably deploy organically or through M&A under their strict criteria.
Okay. So where are you going with this?
So the outrageous idea is this. You go long the stock, betting that management's conviction about a golden age of IB persisting through 2026 is correct.
Okay, long the stock. That's the plausible part. What's the outrageous kicker?
The kicker is anticipating that these sustained record earnings pile up so much excess capital that Morgan Stanley decides to return a chunk of it in a way the market isn't expecting. Not just bigger buybacks or steady dividend hikes.
You mean a special dividend?
A surprise, significant special dividend sometime in 2026, using that temporarily excess capital buffer fueled by the operational success and the regulatory relief.
Huh. A special dividend. That would definitely be an outsized return event beyond standard expectations. It's basically a play on management's own bullish forecast being even more right than the market believes, leading to an unexpected capital return.
Exactly. An acceleration play.
Outrageous.
Outrageous. Maybe. Plausible, given their commentary and capital position. You could argue it.
Okay, so let's recap our deep dive. Morgan Stanley really delivered on that integrated firm promise this quarter. They converted that big cyclical recovery in IB and trading into record results.
Well, crucially, keeping that stable, high-margin wealth management engine humming along.
Right. But management was careful, weren't they? They didn't call it smooth sailing for everyone.
No, definitely not. They explicitly said this isn't a blue sky, all boats steaming situation. They framed it as a return to fundamentals, where the big, full-service global banks, the ones with the whole kit, the global reach, the durable wealth piece, those are the ones set to win market share.
Okay, so here's the final thought for you, our listener, to mull over. Management is putting a lot of credibility on the line with this multi-year upturn narrative and that all-time high pipeline talk. How long can MS hold on to the premium valuation that implies if, say, that IB deal flow falters sooner than expected?
And conversely, what about those strategic investments in wealth management, like the AI tools? If driving future growth means that celebrated 30% margin actually needs to come down structurally over the long term, will the market accept that trade-off? Something to consider.
Definitely food for thought. And as always, we need to remind you that everything discussed here on Talk Tickers is for informational purposes only.
Absolutely. This is not investment advice. Please consult with a qualified financial professional before making any investment decisions.
Thanks for tuning in. We'll catch you on the next deep dive.